Gentleman from Alabama.
Thank you, Mr. Chairman. Thank you for convening this hearing to examine 5 legislative proposals designed to address problems in the $2.5 trillion municipal securities market. All of us are aware of the financial hardships that municipalities across the country are facing, from declining tax revenues, depressed property values, and underfunded long-term pension and health care obligations. In my home state, Jefferson County, Alabama, is on the verge of becoming the largest municipal bankruptcy in U.S. history, caused by the county's inability to repay $3.9 billion in sewer bond debt tied to interest rate swaps valued notionally at almost $6 billion. Some of my colleagues on the other side of the aisle believe the federal government can fix the municipal securities market with unprecedented interventions and bailouts. These interventions include reinsurance programs for which no bond insurers may be able to qualify, and liquidity facilities that will increase the size of the Federal Reserve's balance sheet. It is important to note that for years municipalities opposed federal intervention into their financing operations. Only now, when short-term financing options have dried up, are municipalities seeking assistance from the federal government. Mr. Chairman, of the measures that are subject of today's hearing, the legislation, your legislation to regulate unregulated municipal financial advisors is one that I could support with some changes. We are in agreement with the basic premise that the SEC should require individuals who advise municipalities to register as investment advisors. However, as demonstrated by the Bernie Madoff affair, I'm not sure that the SEC, and I say Chief Haynes with all respect to your agency, I'm not sure whether the SEC has the present ability to effectively examine existing investment advisors. And in that regard, I wonder if it would not be appropriate for this committee to delegate this important examination responsibility to FINRA. Some of the other bills we're considering today are more problematic, including legislation that could have the effect of forcing the rating agencies to rate municipal bonds AAA. It is wrong to assume that municipal bonds never default because they are backed by a taxing authority of the issuer. Moreover, I worry that any bill which directs the evaluation standards for credit rating agencies serves only to further solidify the government's endorsement of the credit rating agencies when we should be moving in an opposite direction. Yesterday we had a hearing on the credit rating agencies, and I made the statement there that I believe the credit rating agencies had failed spectacularly, and that their inability to properly rate securities, I believe, was a major contributor to the financial challenges that we're facing today. And I believe that the government's endorsement of the credit rating agencies and almost their, I believe, has contributed to almost a duopoly in credit rating agencies it was a contributing factor. Also problematic is legislation that would create a federal reinsurer of municipal bonds. Congress does not need to put the American taxpayer on the hook for more losses. The federal government should not be competing with private reinsurance companies that are active in the municipal bond market. Whether it's with these proposals today or in health care, where there are more and more proposals for the federal government to assume private functions, I fear that we've already reached a point where government simply cannot afford the obligations that they've already assumed. And the more they assume, the higher all our taxes will go. The Treasury has no experience in providing reinsurance to municipal bond insurers or at pricing for reinsurance. In addition, a federal reinsurance program for municipal bond insurers simply bails out bond insurers that strayed from their core business of municipal financial guarantees into much riskier financial products. Furthermore, a federal reinsurance program may provide a competitive advantage to those legacy bond insurers that are unable to insure new municipal bonds because of their prior obligations. Finally, a federal reinsurer may scare off new capital into the industry and undermine the long-term health of the bond insurance market. We should all keep in mind that a properly functioning bond insurance market helps smaller insurers to access the capital markets at more favorable rates. In conclusion, Mr. Chairman, I want to give the SEC real authority to oversee the municipal securities market, and I plan to introduce legislation to that effect or work with you on bipartisan legislation. The municipal securities market presents itself to the public as safe, stable, and secure for all investors. It should welcome more sunlight, consistency, and thorough disclosures that apply across asset classes and common sense modernization. Thank you to the witnesses for testifying today. I yield back the balance of my time.
I thank you, gentlemen. Just note